Hey everybody, my name is Nick Caton, and this is our podcast, How Did We Get Here? Communi-Caton. This is a podcast about the people around me and influential people in my life, people I lean on for advice, and those around me that just inspire me to just do better. Meeting up with Jonas. This is our in-house lender here at PMZ. I'm Nick Caton. This is Jonas Pritchard. Jonas, they've had a recent change. They were Scenic Oaks, now Generations. Explain that real quick, how that kind of changed.
Yeah, so we were Scenic Oaks Funding, and then as of January 1st, 2025, we changed our name to Generations Home Loans. The reason for that is we had merged. We had joined with a company that's located more up north, Washington, Oregon, Utah, in those types of areas. And so we combined both. Basically, we've merged our companies and we rebranded and renamed. So everything about that has been great. It's just given us, we've been able to scale up as a company and then add lots of new products and states that we previously weren't able to do loans in. So it's been, all in all, a very good thing. And I've been actually really happy with the name change and the direction that our company's been going.
Yeah, it's been... the success rate still stayed the same. Same people, same quality. I think we get a little bit more for us as realtors. We can broaden our scope for our clients because we have. Let's be honest, we have a lot of clients that are moving out of state or moving elsewhere, and this is another factor. We can help have a familiar face and a familiar brand in those other states as well, and be able to help out.
Absolutely.
It also gets them have. Broadens their packages, their loan packages, and options that they can do for their clients too. So it's been a very, very good thing, I think, for both companies. Like you guys have been doing quite a bit. We had one that sold. We sold one sold out of state, and Jonas had we had a loan officer in Utah that actually did the deal for us. So it was good.
Yeah, that makes it nice because the client was local prior to moving, so I was her point of contact here in the state of California, and then us being licensed in Utah, I was able to secure a loan officer in Utah also. So we had both covered. When she's in Utah, she could meet with the loan officer and talk with the loan officer over there. But being that she was local here next to my office in California, it made it very easy for her to come down and meet with me also. So she basically had two loan officers, help guide her through the process, and I thought it worked out really well. And it was good for the client, and I think good for all the parties concerned.
Talk about the importance. I know for me, it's a huge. Most local realtors talk about the importance of what it's supposed to be for having a local mortgage lender in the local area. What plays the benefit for us? I know for us as agents, it's nice to know a familiar face and a familiar name, but when we try to express that to clients, it's just I try to tell everybody. I use this adage, and you're gonna laugh when I tell. It's easy to come down here and knock on the door and talk to the loan officer when you know who he is and where he's at. It's kind of hard when they're in Maryland trying to do a loan in California, and there's a little bit of difficulties. And then on the other side of that too, as a listing agent, you don't have the familiarity with the loan officer. So I know.
Yeah, I think there's kind of three legs to going with somebody local that you know and trust. One, I think a lot of it has to do with accountability. So we all can just call anyone and get any kind of advertisement online or thing about a rate. But what you don't know is, one, what's their underwriting process? What's their how long does that take? What is the experience level of your loan officer too? A lot of times that people, not all, but in a lot of situations, people who generally are online loan officers are newer in the business. They're order takers. A lot of times they don't have an in-depth product knowledge of maybe all the different options that you have available to go to. And so you could run into problems there, but perhaps being placed in a program that isn't your best program. Time constraints, there's a lot of lenders who, one, they don't have accountability because they're dealing with lots of people all over the United States. Whereas I'm local, I'm in office, I see these real estate agents every day, I meet with my clients, if they're available in person. I think that just makes a world of difference because I have a lot of accountability and I'm invested in this transaction to make sure it goes smoothly and closes on time. Where you can, in certain situations, run into people who, I'm in a cubicle in another state, and this is one of maybe lots of people that are calling me, there just isn't as much accountability to what we have to do on a daily basis with contingencies, closings, getting docs out, in an appropriate time frame. So there's a lot of different factors, but I just think it's going with someone who's local that you trust. Like Nick said, Nick can come to my office door and sit down with me and talk about, hey, where are we at? What's going on? So that way we make this, the process as seamless and problem free for not only our client, which would be a buyer, but then for the sellers too. So I think it just all comes together to make it just a better experience, more loan programs available. There's various reasons why you would want to go with, I think somebody that's local to your area, local to the market, knows the agents, knows appraisers. I mean, the list can just go on and on.
Yeah. When we talk about the home buying process, it usually starts with the client coming in and meeting with an agent, and I know we have a really good process, a successful process that happens with a lot of our clients. So, but it mainly comes in and starts with the agent. Somebody calls up interested into a house, or we have a client from our sphere that asks us about, hey, I'm thinking about buying. What do I need to do? And we'll talk about a little bit about that process though too. But what's basically your process for onboarding new clients and new prospects for purchase loans?
Yeah, first thing, I kind of want them to give me their story. I mean, I think that's an important aspect of it. Okay, what do you really want to do here? What is it that you are wanting to accomplish? We've talked about if you could wave a magic wand. Yeah. Tell me what would be kind of the three things.
What's ideal?
What's ideal? What are you looking for here? And that can really help me. And then sometimes I can even get background. Are you looking to, hey, we're just looking to buy this house, be in there a year or two, sell it, move on? No, this is going to be our dream home. We want to live in this house forever. Or it could be, yeah, this is a house that we're buying, but in 12 to 24 months, we want to rent it out. So that, just all these scenarios, finding out, well, how much funds do you have to contribute? So it's kind of just a story. What type of payments are you looking for? So that way we can have I can have a better understanding of, okay, what is it the client is important to the client, and what can I do as a loan officer to fit the right product and terms and interest rates to fit the needs of the client. But pretty much it's our introductory, like I said, getting background on the client, what it is that they're looking for. The next point, it's just really basic. It's filling an application out. Application, we're just looking at, okay, where have you worked the last 2 years? Where have you lived the last 2 years? What type of assets do you have? How much of these are going towards it? Of course, I'm going to pull a credit report. These are all things, pay stubs, W-2s, things of that nature. So that way I can get a good financial profile put together. So when I'm pre-approving them, I actually have documents that I'm looking at. I'm doing my income analysis and various things. So that way we know that this is a solid pre-approval. And so when I give Nick my letter after discussing some of the terms and loan programs that I think might fit them best, we come to decisions on, okay, this is the one that we want to choose. And then from that point, they're pre-approved. Now they're pre-approved. Now that means generally I'm going to call Nick, say, hey, just want to let you know, Mr. Smith came in, we talked, we ran through the numbers. Here's where their purchase price is at. This is the type of loan program they're going with. And then he will request a pre-approval letter from me, and then I send that over to Nick. So that's the process. It's not overly complicated, but there are important parts. The paperwork is a very important part because that's generally how we're going to base a lot of our decisions on. So it is important that when a loan officer asks you for different things or document requests, that you try to get them over as soon as possible. And it's to protect the client too, because I don't want to get into an escrow and then there's something that I maybe didn't get enough documentation on and suddenly it's different and we don't want to be in contract and therefore having to make changes midway through. So the pre-approval process is just very important, making sure that we have our T's crossed, our I's dotted, so the real estate agent and the client can go out with confidence and knowing that they're going to be putting offers on homes, that we have a loan to back it up.
See, it's important though too is, and once you get into the application process, we start, and Jonas, and we'll hit on this though too, is there's this myth out there, you need 20% to be able to put down to purchase a house. That's not always the case. A lot of people qualify for FHA, or maybe even VA loans if you're a veteran. You qualify for those type of loans, and so you don't have to come in with a ton of money. There's programs out there that are able to help first-time home buyers. FHA is usually about 3.5%. They're doing conventionals at 3% right now too, depending on credit and different things that they have going on in their lives. Work history, different things like that. But I just kind of want to destroy the myth that out there everybody thinks they need to put 20% down. Right? I mean,
no. I would say the
process?
majority of my clients don't put 20% down. Depending, we have products that can go up to 100%. We have down payment assistance products that can help first-time home buyers get in at 100%. VA has a 100% loan. So there's a lot of different options we have that can really reduce the amount of funds that you need to bring in to buy a house. It isn't, I need to put 20% down on a $500,000 house. I mean, that's $100,000 plus closing costs. That's not the case. There's generally, there's lots of programs that you can do, like I said, 3.5%, 0%, 5% down. That's part of the pre-approval process. We go through and we find out, okay, what guidelines, we call them guidelines in the business, which are basically almost like the rules of the loans. What loan is going to fit you best, and what loan do you fit the guidelines for? So we know that we can get you in for, as much as 0 down to 3.5%, 5%. There's also a lot of people don't understand. There's a lot of alternative documentation loans out there too now for people that maybe don't fit the traditional profile. Maybe they have a lot of assets. We have asset depletion programs where we can actually get income from the assets that you're going to retain after the close of escrow. For self-employed people, there's 12 months business bank statement loans. So there's different ways, and I would get into that if it looks like that's going to be a better option for the client. But there are lots of loans out there. So a lot of people just think of just your traditional 20% down, 30-year fixed. I mean, we have 30-year fixed, 25-year fixed.
15 the other day.
10-year fixed.
Yeah.
There's a lot of different options that we can look at for people that may give them, save them on interest money, and also as you reduce the term, a lot of times you're in a position where the rate's going to be lower too. So don't ever be afraid. Maybe especially like people that have maybe their income's a little bit different. It's always best to talk with your loan officer and let's go through it, because there are a lot more options on the table in what we would call more like alt-doc, alternative documentation for certain types of buyers.
When you're doing, so I'm a first-time home buyer. I come walking in. What are the common mistakes I have, or what are some of the things that I get 2 questions out of this really. What are the most common mistakes, and then what should I be prepared to be doing? What things should I be prepared for? And then what mistakes do you find usually with first-time home buyers they make, basically? I mean, is there any highlighted things, like top 2 or 3?
I think the hardest thing for first-time home buyers is a lot of time they have a very limited amount of funds to close.
Correct.
So there are ways you can do things there. Gifts are available. A lot of first-time home buyers will get gifts from their parents. They don't really think that could be a source where an aunt, uncle, brother, sister, they have the ability, and it could be from multiple sources, to help you if we need additional funds to close. So that's something to definitely keep in mind. Also, a lot of people sometimes don't know that even there's certain 401k accounts you'd need to talk to your administrator, but sometimes they've even been able to pull some funds from there, either just taking those funds directly out of certain types of investment accounts, or in some cases, employers allow you even to take a loan against your 401k. So those are things that we can discuss too. So one of the things is
options, man.
Yeah, a lot of options. So a lot of things what I see is, just there's different options that sometimes first-time home buyers haven't even thought about or don't even know exist that could help them get into a home. There's pretty obvious things. Make sure you pay your bills on time. It doesn't make a difference to me if you have a $10 payment and you're 30 days late, or you had a payment that's $5,000 a month and you're 30 days late. The algorithms basically treat those the same. So lates are lates. So we just want to make sure that we're doing what we can. Another one is sometimes people say, yeah, I have X amount of dollars to use towards a purchase. Okay, where is that X amount of dollars? Oh, it's in cash. I keep it here or there, but it's not in an institution. So that's a good thing to come to me and talk about, because then we can talk about steps to, how maybe we can overcome that, or what they can do to so those are usable funds, because generally large cash deposits over a certain amount, and it can depend on lender and the type of loan that I'm doing, can't be included in funds to close if they've been deposited within the last 60 days. So that's why you talk with the loan officer. That's why we sit down. So we can lay out, hey, here's the best option. Some people say, well, I'm going to use all this money and I'm going to pay down this debt. That's going to look better to a loan officer. Well, not necessarily so. Sometimes I would rather have that money not paid in debt, because I'm not having a debt to income issue. I'm more having a funds to close issue. So by talking to me first before we pay down debt and do different things, I can then give them a better understanding of what I think might help them better in achieving their goal, which is home ownership.
So talk about first-time home buyers. Now we're talking about empty nesters. Mm-hmm. You know, lived in the home for 10, 15 years, maybe more, and they've acquired a significant amount of equity into the place. We did a deal last year that they're downsizing, and they actually worked out where they purchased. We pulled equity out of the house. We were able to purchase the second home, or the home that they were downsizing into, and then sold the house that they moved out from. And what was the time period in that? It was 90 days or so. But discuss about that, how that process kind of works. Again, this is people that are looking to downsize, and what does that look like? And they still want to be able to capture a little bit of the rate and the write-offs that you still acquire from purchase.
So another option we have that people don't think about is, I have a home. I owe $100,000 on it, but it's worth $600,000. So they have, and the equity, it could be all kinds of different. It doesn't have to be that much, but basically just an example. So in this situation, you owe $100,000. Your house is worth $600,000. So, approximately you could have close to $500,000 in equity, but you want to buy a house and you don't want to sell your house and buy a home at the same time. Well, we have options for what's called bridge loans. Well, bridge loans can take the existing equity out of your home, and you can use that to buy another house. And so that's something we can talk about with me too. So then what we like in this particular situation, the clients bought the other home. That one was done and closed. Then that gave them time to move, place their house on the market, and then sell their house at a later date. So there's like I said, there's a lot more options available for lending today. And if you have a unique situation, don't think, well, I don't want to have to do contingent on, or they're running into problems putting in contingent offers. So this is a way that you can actually pull cash out of your existing home to buy another house as a bridge loan, sell the house, and then that pays that loan off.
So we have an expanding inventory here in the Central Valley, and it's starting to grow. So there's a lot more options for buyers right now. I'm talking about properties to look at and be able to view. So when houses start sitting on the market, people start getting a little more creative to look to purchase. So, I'll just use here at Oakdale as an example. We've gone from last year at this time, it's about 40 homes on the market right now. Now there's almost 70 homes on this week, single-family residents on the market. So if I'm Joe Blow and just want to go out and thinking about buying a house, this house has been sitting, it's a little dilapidated, maybe needs a new kitchen, needs a few other things like that, and it's been sitting, but it's in a location that I find ideal. Maybe it's close to an aunt and uncle, or close to mom and dad, something like that, but it just doesn't. It needs some work, needs some help, and it's been sitting on the market for a while. How does that work with renovation loans? I mean, there's loans that you can actually qualify for to be able to get renovations where those places get a little bit fixed up before you even move in, right?
Yeah, I think renovation loans are a great option that's very much underutilized. So there are homes out there that just for whatever reason, might not be able to do traditional financing on. Maybe there's some health and safety. Maybe somebody was in the middle of a remodel that wasn't able to get completed for whatever.
We had an agent here just close one. Yeah, that's right.
So maybe because of whatever situation is with the seller, death, divorce, there's things that happen, and they just want to sell the house as is. Well, a lot of times those homes can be sold at a significantly reduced rate compared to other homes in the area. That could be a perfect home to where you don't have to buy it, and a lot of times that would be all cash, and then you have to have the money left over to finish the repairs. We have basically a rehabilitation loan where we can go in and you can buy the house as is, and then after close of escrow is when the repairs are done. So it closes, you can do a traditional, 34, 45-day escrow on something like that. And then after it closes is when we actually do the repairs. And it's a great loan program. It's underutilized. A lot of people don't know it's even offered out there. But that could expand inventory or expand to a house that you really like. But you're just like, it just needs so much work. I really love the neighborhood, the school district. I love everything about this house, but I don't have $50,000, $60,000, $100,000 to put into this home to make it mine, to bring it up to the standards that I want. This is a loan program that you can use. So it's just another thing that you can think about, another tool in our tool belt that we can help people get into homes that maybe perhaps they otherwise think they wouldn't, there was no chance or they couldn't even qualify for.
Yeah, or they just were in a box and they were thinking, I need to buy this at 20% down and I need to add another $80,000 into the place. Well, you get a renovation loan.
Yeah, you can do FHA renovation, conventional renovation, 3.5% down, 5% down. So there are those options that we can look into and see, hey, do we qualify for this? Is this something that we can do for you that can help you achieve the home ownership of that home?
So, real quick, and we're trying to wrap this up, the question everybody wants to know when it's talking to mortgage lenders, hey, what are rates doing? What are rates at? Where are we doing with rates? What do you think? Where do you think it's going to go? Is it going to come down? Is it going to go up? What's going to happen? What's going to happen with rates? And we always laugh. Me and him talk about this all the time. If I could tell you what it's going to do in 6 months and have my crystal ball, we wouldn't be here talking like this. We'd be sitting on the beach somewhere in Hawaii because everybody wants to know. I can't give you a definitive answer. I know he can't give you a definitive answer.
No.
But we can kind of give you ideas or signs of what things are going and tell you what's going on today, So what's going on today? This is, this is the second week of, the third week, of July. And so what's going on today with
Yeah, well, lately the market's been kind of sideways. And I'll just give you average stats. But there's average rates out there. But people want to know, okay, what are rates going to be doing in the future? And so, the short answer is nobody really knows. It's because it does take data. It goes off, it depends on what the Fed...
Many factors.
Yeah, what the Fed does,
factors.
mortgage-backed securities, 10-year Treasury notes. All those come into play that influence what our interest rate's going to be. So, short answer is nobody knows. Now, a more nuanced answer is we do feel that there's a lot of signs, I don't want to go through a whole economics spiel here, but there are a lot of signs that it looks like that we may have, in the foreseeable future, I don't know, months, but hopefully within the next year that we could see rates start to trend down. Let's hope that's the case because I think that it definitely helps people in their payments and buyers getting into homes. But it's still very much up in the air. I do have a feeling that we will, as we progress more towards the end of this year and into 2026, I do think that we're going to see better rates rates start to go down and rates starts to lower. But again, there's many factors that can influence that.
Yeah, but don't think you're getting 3.5 interest rates in next September. That's not happening.
I don't know if that's ever going to happen. But that's still kind of up in the air. But
you see a half.
I think we could
a quarter. By the first of the year. Hopefully, we've been saying that all year long. We're trying to see that, but knock on wood, we get down a little bit, and I just don't. We're not going to see that 3.5 rate. It's not going to happen. But when things start ticking down, making things more affordable, and that gives my next question: what do we judge affordability on? I know as agents, we tend to talk to. We always talk about what's their story. Well, they found the perfect house in the neighborhood that they want, okay? But maybe it's not just it's not affordable for them. Or they're stretched out a little bit. What really deems affordability for most buyers? Is there a ratio that they look at? Is it just, hey, are you comfortable with this? Are you comfortable with that? Or is there something that we really look at? I don't look at that end like that. I'm the guy that's shopping the houses. He's the guy that's always talking about the bank account and looking back, hey, what are you comfortable with here? What's affordable? What are your means of living, and what does that look like? But I mean, when you start talking first-time home buyers, even people that are buying second, third homes, they start getting stretched out like that. Is there affordability standards that you really kind of talk to when you talk to people about things like that, or?
Yeah, so some standards are placed on us by the loan program themselves, and different loans can have different what we call debt-to-income ratio. What that just means is how much debt you're carrying, things like that appear on your credit report, cars, credit cards, and your house payment. We're looking at that debt-to-income ratio of the house itself, and how we do that is through an income analysis, and we determine what gross usable income is. And then there's a percentage of that. Now, and some of it is going to be influenced too by how much your down payment you have, what your credit score is. That can allow so this is variable because that can allow for higher debt to income ratios. But generally, what I'm going to do is I'm going to do an income analysis. I'm going to look at how much the house payment takes up of that of that usable gross income, and then also I'm going to look at then in conjunction with all of your debts. Those two combined are kind of what we call our back end debt to income ratio. Now, most programs you can go up to a 50% of your gross income a back end debt to income ratio. Now, some people that's comfortable for them, other people that's not. So I can have a maximum approval amount, which means I could say, well, hey, I can approve you, and I'm just throwing numbers out here. I can approve you for a $600,000 purchase, but that may be uncomfortable for the client, which isn't a problem. Now we can just back it down to find their comfort level. Because some people are going to say, for me and my family, this is affordable to us. Other people that may have the exact same income may say, you know what, actually, I'm more comfortable going with a higher payment. But generally speaking, we want your total debt to income ratio, including the house payment and all your debts, to be under 50% of your gross income. That's generally the limit on most loan programs. Some of them exceed that. Some of them are lower than that. But again, that's why the pre-approval process is so important, because there's a lot of things that I look at. And then also we talk to say, okay, even though I can do this, maybe you're more comfortable at this level.
Right.
And then that's what we're discussing. And then we know, and then that way too, we can communicate that with the realtor when he's going out and looking for homes.
Yeah, and lifestyle plays so much of a
part. Yeah, lifestyle, everybody's different.
Yeah.
I do know a maximum I have, and if we can't exceed that, that's kind of what's called our cutoff. It doesn't matter if that's the maximum amount the loan will approve you for. But then once we get underneath that, it's going to be to each person individually.
So trying to wrap everything up here. Thanks, Jonas, for being here.
No, thank you for inviting me.
But I want one piece of advice, and one piece of advice from the realtor, one piece of advice from the lender, of what we get for clients. Okay, in this time right now, again talking July of 2025, we're seeing expanded inventory. Things are coming up, and I've been preaching this the whole time, though, too, is that if you are a buyer and you're sitting on the fences and waiting for this house to come up, I highly, highly, highly suggest it's something that you can get into. Find a way to get into that place. If it's something, we here at PMZ Oakdale, we talk about the 85% rule. If it clicks off 85% of your boxes and it's something that location's ideal, floor plan's ideal, these are some non-negotiables that are in this place that I gotta have. But, right now it's a stretch. Well, yeah, it's going to be a stretch. But we've already talked about, right now, these are the times that rates are probably going to stay a little high. Not inflated, but they're higher than normal. But that property might not be available when rates start to come down. So maybe it's time, hey, you jump on it, feel the squeeze for a little bit, get a little bit more comfortable, then think about refinancing in a couple, 3 years. When rates come down, make your life a little bit easier. You get a little more equity in the place. Maybe start adjusting your house where you get rid of. Say you went in at a 3.5% FHA. After 3-4 years, maybe equity's jumped up over 20%, and now you qualify for you get your PMI taken off. Your rate's a little bit better, and your payment's going to be a little bit more manageable for you. Make it a little bit easier living. But right now, as agents, I'm highly, highly, highly getting in front of my buyers right now and explaining to them that, hey, there's a lot on the market. Okay, so if that house does come up, it's time to jump on it right now. But it's got to be something you're going to be comfortable with the next 5 to 7 years, because in reality, that's where this is going to be sitting right there, right? But that's my one piece of advice right now. Jonas, what do you got?
Well, sometimes people are apprehensive to talk with the loan officer and to start the process for whatever various reasons. don't ever be afraid to.
Yeah, because you just don't walk in and pull your credit, right?
Yeah,
They don't-
yeah,
they don't do that
no.
right away.
I mean, a lot of times too, I talk to people, and sometimes it's good to talk to them even when they're not ready, because I try to set them up. Okay, if can do this over the next 6 months, or I've had clients I've dealt with for 2 years before they got into contract on a home. So, but it's good to know in the beginning, so you don't see a house. You want to put an offer on that house, and there's some kind of maybe small item that we could have addressed or taken care of that could have allowed you to purchase that home, but you just came to me a day before you wanted to put the offer in. So sometimes before you found a house, just come. It doesn't cost anything to get pre-approved with me and Generations Home Loans. It's good to have a conversation, talk. If you give me permission, I can pull your credit. We can go over it. We can discuss, here's how much payments are in this price range. Here's how much money you need to bring in. It's just information, becoming knowledgeable, knowing, because I feel, and I've always felt this, I bought my first house at 22. I feel that for most of us people who are in our income range, some of the greatest wealth builder that one of the greatest wealth builders that you can have is buying a house, having that security, building that equity up. Homes have always tended to be, in most situations, a very good investment long term, and I've never been unhappy with any of the homes I've bought. It's just something that I feel strongly about. I've pretty much been a homeowner since I was 22, and all you need to do, and really just making a phone call and talking with me a little bit, and talking with Nick, even if it's not the right time, at least we can put you on the path to you knowing, okay, when it is the right time, I have a pretty good idea of my payment, how much money I need to bring in, or if there's some items that we see, maybe on credit or something like that we need to work on, we can develop a plan to work on that together.
Yeah, it's funny because they always start the process with the agent. Buyers do. Hey, I'm thinking about buying a house. Okay, have you talked to a lender? Well, no. Well, actually, I'm not the first guy you should be talking to. That's the first guy you need to be talking to. Because it starts the process. I understand that you're out looking, and everybody thinks, oh, I have this, I have that, I have this. It's great. But, to get yourself in the best position possible, you always start talking to a local mortgage lender, and local, not somebody that's 1-800 go find a house. It's talk to your local guy, your trusted advisor here locally. It's always good to be able to sit down and sit across from a human being and talk and express, hey, this is what I need, this is what I don't need, and it's okay to ask questions. Remember that though too. Not everybody is familiar. We do this day in, day out. This isn't for everybody, not everybody does or knee deep into this stuff like we are every day. So it's okay. It's okay to ask questions, and I find it highly favorable and get you in a better position to go out and be able to purchase after you've already talked to a lender. So anyway, thanks Jonas for being here.
Oh, thank you, Nick.
Thanks, man. I appreciate it. Always appreciate your time. I can't thank you enough because. But if you ever need anything like that, feel free to reach out to me, 209-380-7083, or even Jonas. What's your number, Jonas?
Jonas Pritchard, Generations Home Loans. My cell phone number is 209-402-1305.
Thank you. Make it a great day.
You.